Welcome to Chapter 2. A key principle I believe this chapter deserves to be started with is your actual investment amount. Although this simple law applies to every form of investment you make, whether that's a car, a stock tip, or a leveraged forex trade, applying and practicing these principles into cryptocurrencies is a whole new ballgame. We first have to take into account there are no demo accounts available for cryptocurrency trading yet. Therefore, once your trade is placed live, it's exactly that, live, no practice runs. This means we really need to take a deep and calculated breakdown into each and every investment we make, analysing in advance the risk versus reward for any given trade. First and foremost, the market moves unlike anything you've seen before. We can very easily see increases in the value of our investments of 100%, and sometimes higher in a single day. The true definition of a high risk, high reward market. Of course, the same is also true of decreases in the value of our investments. A fall in value of 100% is very unlikely, but unfortunately, the same cannot be said for drops anywhere from 20 to 80%, as the market is still in heavy speculative waters, meaning regardless of actual use case, a coin can very easily fall down 70% and regain most of its losses eventually for no given reason. The reason I suggest and mention this before anything is because we need to take this information and absorb it. This needs to be drilled deep in our subconscious mind until this becomes a conscious thought we can evaluate and act upon before ever pressing the buy or sell button. Evaluating yourself and your own risk appetite is essentially what will make or break you in this market. We have to go deep within and break down how we think and act when it comes down to handling money in a majority of situations. Here are some scenarios for you to really understand yourself. Do you always go big at the casino? How do you handle your wins and losses? Do you tell yourself just one more spin? Or do you accept the losses, leave with what you intended to lose and call it a day? When you spend more than you should have on a night out with friends, how do you feel after? Do you get angry and blame others for making you spend more than you intended? Or do you shrug it off and realise this was a result of your own actions? When an opportunity arises to make some extra income, for example from a friend's advice or an investment magazine, do you immediately hand over your money and trust them? Or do you stop and think whether this kind of investment is something you would take without their advice? As investors, we have to be smart of our capital and how we diversify our portfolios. Every investment portfolio has room for a high risk, high reward asset, but that doesn't mean you fill the room with everything you possibly can. Nobody likes to lose money, but I guarantee you will sleep a lot better at night knowing 1 to 20% of your life savings are gone compared to 90% of your life savings disappearing overnight. If you realised your answers were more in line with the final questions as a premeditated investor, you will find it much easier allocating larger portions of your investment to cryptocurrencies. Whereas, if you fit the criteria of the first answers as an individual potentially more reckless with finances, holding 1 to 5% of your portfolio in crypto is more aligned with your personality. The beauty of this market is that small allocation could easily turn to a much larger portion in a short space of time. We now have to weigh up the odds of risk with the reward. Ethereum at the time of writing hit an all-time high of $407 mid-June. That's a 5,000% gain since the start of the year when it was trading around $8 just 6 months ago. Bitcoin excelled to almost $5,000 in August from its starting price in January of just $1,000. That's a 400% gain in 8 months. Litecoin was just $4 in January and now currently trading at around $90 in September, around a 2,150% increase. Finally, another large gainer was Ripple's XRP token, valued at just 0.0065 cents at the start of the year, before reaching a milestone in May of 40 cents. That's around 6,000% in 5 months. Let's break this down into its simplest form with a real life scenario. From the perspective of a relatively small investment and a slightly larger investment, we will use $200 and $2,000. Had you invested either of these sums on January the 1st into the 4 cryptocurrencies we just mentioned, at the all-time highs you would have received roughly, for Ethereum, $10,000 and $100,000. Bitcoin, $800 and $8,000. Litecoin, $4,300 and $43,000. Ripple, $12,000 and $120,000. To put this all together and help you align an overall premeditated mindset to emotionless investing, look at the current amount you are willing to invest. Remember, if this investment amount affects your ability to cover everyday life expenses, such as bills, food, water, or emergency funds, it is too much. For example, you have broken down your expenses, you have enough to cover utility bills, a solid amount in a rainy day fund. You have calculated that around $5,000 can comfortably be invested into the crypto of your choice. The risk of this investment in its absolute worst case scenario is 100% loss. The entire amount you invested falls to zero. We accept this and move on. Remember, we are not margin trading, so your loss can never exceed your investment amount. The reward is technically uncapped. Arguably every single cryptocurrency tradable on an exchange has seen a return of at least 100% at some point. For example, investing in Bitcoin in the beginning of the year would have got you seemingly a modest 400% return, small compared to the likes of Ripple's 6,000% gain. Yet, if you had invested in Bitcoin early 2010, your gain at this current market price of a $5,000 investment would have been 500,000%. To put this in its full perspective, the FTSE 100's highest gain this year is 5.7%. So we have the worst case scenario of losing everything versus the upside of at least double your money in the short term, a 1-to-2 risk-reward ratio. If we stretch this investment horizon over a longer period, say 1 to 5 years, the risk slowly begins to diminish and is outweighed massively by the potential for astronomical gains in the thousands of percent. When we apply this long-term mindset into our investment, we can accurately calculate and accept the risk of short-term losses. Sitting through market corrections, knowing your investment could easily be worth quadruple a year later.